When you're interviewing for investment banking, you can expect to be asked accounting questions. One of those is, how does a gain on asset sale affect the free statements? And to illustrate this question, we're going to assume that you sell an asset for $120 at a book value of $100, and we're going to take a 30% tax rate. We're going to use the same structure that we did when we discussed the $10 increase in depreciation question. So we're going to start with the income statement, then we're going to go to the cash flow statement, and then the balance sheet. This is just a really helpful way to think about it, and it's also the way that the interviewer is usually going to expect you to deliver the answer. Remember that you're only focusing on the incremental effects. So you're really just focusing on how this is going to marginally affect all the statements. You don't have to assume that there's some existing financial statements. So we start with the income statement, and the gain on the sale of an asset is recorded, but we're only looking at the difference between what it was sold for and what it's on the balance sheet for. So in this case, it's 120 minus 100. So you're going to record the $20 as a gain on the sale of an asset. And because this is most likely not the core activity of the business, it's going to be in another non-operating section of the income statement. Then, because we've got the 30% tax rate, you subtract the taxes, so it would be 6, and this leaves you with a net income of 14. Then on the cash flow statement, you would start with the net income again, so that's the 14, and then you subtract out the non-cash, non-cash increase, which in this case is the gain on the sale of an asset, because if you think about it, these 20, it's not really cash. You've sold it for 120, so the 20 is just this difference, and you're taking it out because it's non-cash benefit, but also to reclassify it, because you're going to classify the sale in the investing activities section. So you're going to record the full amount, which is the 120 there. And if you net this out, so the 14 minus the 20 plus 120, it leaves you with a net change in cash of 114. And just pause and think about this for a minute. You've sold the asset for 120 and you paid 6 in tax. So it makes sense that the actual cash you're left with at the end is 114. And we take this amount and carry it into the balance sheet. So if we go into the balance sheet, you've got the PPE amount, which will go down by 100. You've got the cash, which will go up by 114. So the asset side is worth 14. And on the liabilities and equity side, you've got the net income that flows into retained earnings, and this will also be 14. So the two sides of the balance sheet balance. Thank you so much for watching.